Good morning, everyone, and thank you for tuning in today. I am Eric Eady, CEO of CFA Society San Francisco, and it's my pleasure to welcome you to our webinar, Hard Assets in Hard Times, Protecting Wealth with Commodities and Precious Metals. A quick item of note before we start, you will be muted for the event, so we encourage you to type questions into the Q&A box. We will monitor those questions closely and endeavor to have as many questions answered as possible. This event is being recorded, and we will share the replay shortly after the call. Now I'd like to introduce our moderator, Chris Hartman from State Street, who will introduce our speakers. Thank you, Chris.
Thank you very much. Again, Chris Hartman, State Street Investment Management. I'm the regional consultant covering RIAs across California. Pleasure being here today. First and foremost, thank you to the CFA San Francisco for bringing us all together for this timely discussion. In a world where inflation has moved from a textbook term to a daily headline, and geopolitical shifts are redrawing trade maps, the old 60-40 portfolio is under fire. Today, we're looking at the stuff that makes the world turn. Today, we're joined by Doug Cowden, Chief Investment Officer and partner at Baker Avenue Wealth Management, a multi-billion-dollar asset manager and family office based in San Francisco. Ditesh Shah, Head of Commodities and Macroeconomic Research at WisdomTree. And Akash Doshi, Head of Gold Strategy at State Street Investment Management, who prior to joining State Street, spent over 13 years in the institutional sell-side research division at Citigroup, and most recently, Head of Commodity Strategy for the Americas. Thank you all for joining us here today to share your insights and expertise.
Thanks, Chris. Glad to be here.
Of course. Well, we'll jump right into things. I know we've got a lot to talk about. Obviously, it's a very timely topic with the global macro setting right now. We'll look at structuring this here. So we'll start with Nitesh, then Doug, then Akash. But first off here, there's a lot of talk around a new commodity super cycle driven by underinvestment and the energy transition. Do you believe we're in the early innings of a long-term bull market, or is this just a temporary spike driven by geopolitical conflict?
So we've been talking about a super cycle in the specific materials that are useful for the energy transition, which really is an energy addition story rather than transition story. We've gone through years of talking about moving from hydrocarbons to renewable sources of energy, and we haven't really moved. We've just added more renewables on top of existing energy assets because the world is so hungry for energy. But the word super cycle in its true term, I think it should be reserved for a broad-based commodity cycle where there is massive amounts of demand and supply just simply can't catch up. Yes, we see that in energy addition, not necessarily everywhere across the commodity spectrum. But we do think we're on a commodity bull cycle at the moment because all commodities are doing well. And even, up until, say, a month ago, where energy seemed to be lagging, we had oversupply of oil and, natural gas in parts of the world. Even that is now looking tight after the start of the Iranian war. So it is a broad-based commodity bull cycle. But super cycle may be in certain sleeves of the commodity spectrum.
We tend to agree, Chris. I'd sort of side with the former, the way you laid it out. Underinvestment in energy infrastructure, what we're seeing from an energy demand point of view, specifically out of the AI verticals, as opposed to any sort of temporary spike caused by these geopolitical events, at least over the last month or so. So, I think it's worth noting that, power, energy, infrastructure, those markets were already assuming market leadership, prior to the war, if you will. So we think that speaks to recognition of those trends, those secular trends, if you will. Of course, the war has added a tactical catalyst to pockets of the commodity complex. I agree with Nitesh on the word super cycle. That's a dangerous term. When you think about asset allocators like ourselves, they tend to be dynamic. We like to change it around. And super cycle, if you think about what we learned through the textbooks. That was multi-decades of a long period of high prices and high demand. With the amount of innovation that we see, particularly in the energy complex these days, I think you need to be careful about using that term. But when you think about the intermediate term, let's call it, and I'll use it in a broad stroke and talk about the commodity complex. Yeah, I would say early innings of what we see are some powerful tailwinds to the complex in general.
And just to elaborate on that briefly, when you say intermediate term, what kind of timeline are you referencing there?
Let's go, somewhere around the 5-year cycle, and let's be very careful about, extrapolating growth rates into the 10 plus years, given what we see is also a very robust innovation cycle addressing a lot of the energy needs as well. So, but at least for the intermediate term, we think we've got some powerful tailwinds here, Chris.
Thank you. Akash.
Yeah, look, I think I echo some of the points Doug and Tesh said. I would just say when we were last in the commodity super cycle, from the early 2000s up until 2012, interrupted by the global financial crisis, you had a couple of factors in play. One, China was growing double digits, India was growing high single digits. You were very supply constrained on the energy side. You didn't have US shale as a spigot you could turn on and off. That's lowered the marginal cost of energy extraction for both gas and oil substantially since over the last decade. And then you also had a situation where you had some policy effects. For example, the US introducing biofuel standards that really marginally increased the use of soybean and corn, for example, in renewable energy production. I do think the possibility of a metal super cycle or a silo super cycle within certain sectors is plausible. However, it's very difficult to see a commodity super cycle without oil participation. If you look last year, crude oil prices were down around 18%, almost near a bear market. In fits and starts wasn't a bear market in 2025. Look, earlier this year, oil was pretty comfortable in the mid $60s a barrel. Molecules are tight now because of the Strait of Hormuz disruption, but that is a geopolitical shock and a man-made shock, not necessarily a shift out in the aggregate demand curve. Pandemic itself took 4 to 5 years of oil demand growth. Only in 2024 did we reach 2019 demand levels for global crude oil markets. So I think without crude oil, very tough to have a broad-based commodity super cycle, especially given oil weights in commodity indexes.
Interesting perspective. Yeah, thank you for sharing. Akash, I don't know if there might be a slight issue with the connection there. There was parts of the discussion that were a little bit choppy as far as maybe the Bluetooth connection. So I don't know if you have a different microphone that you might be able to tap into, but just be aware. Um, shift a little bit more to the current monetary and fiscal policy. The Fed just held rates steady at 3.5 to 3.75 range this month. We're dealing with the stickier 2.7% inflation rate and also the oil shock from the Iran conflict. We're seeing a
Sorry, everyone. Hold on one second.
Chris
Looks like
might have
Chris
frozen.
has frozen. Sorry, everyone. Hold on one moment.
I think I know where Chris is going with this question. If you want me to sort of talk about my sort of response to what I think he was asking us,
That'd be great.
while we wait for him to reconnect. Yeah, it's certainly true. The Fed's job has become significantly more complicated more recently. Um, that jump up in prices makes it much more difficult to cut rates, and the markets were expecting some rate cuts earlier before the conflict broke out. But there was a lot of uncertainty with the Fed, period, right? Constant attacks on the Fed from the Trump administration led to a lot of uncertainty, and that's why gold prices at times this year were rallying. Right, it's only up until the nomination of Walsh, a sensible candidate, did gold prices really calm down. But we still don't have a huge amount of certainty as to when the change in the chair will happen. Because Congress has to approve, and that's clearly not going to happen until the Department of Justice subpoenas or issues are resolved as well. So there's a lot of Fed uncertainty, and that's something that's there in the institution, but also in its decision making. Yes. Uh, we are in the late part of an economic cycle and things are cooling, but the labor market's not falling off through the floor. Maybe it's being supported by the fact that there's not a huge amount of immigration in the US, and therefore labor markets have become tighter just because of that. But on the pricing front, even without the war in the background, prices weren't. Um, they weren't decelerating. We were way above, the 2% target, and there was nothing in the forecast to say that it would get to 2%. So the urgency for rate cuts wasn't really there. The next question is, well, does the increase in oil prices, energy prices, really drive a need for rate hikes? And I know markets are expecting rate hikes, but it is an open question. I think it's very unlikely in current circumstances. I mean, if Trump is attacking the Fed right now, if talk of the rate hikes were to emerge, that would be absolutely disastrous. And I think the Fed acknowledges that um, the energy price shock is not in its control. It can't do anything to uh, kill off inflation or the sources of inflation. It could engineer a recession to dampen other prices to counter the increase in energy prices, but it would be very painful and probably unwarranted. Um, uh, the fiscal stimuli that's coming from the One Big Beautiful Bill will be once again inflationary as well, but the Fed may decide to stay clear of that. But elsewhere, if you look around the world, you've got market expectations for the ECB to raise rates almost three occasions this year. I think the market swung way too much in the wrong direction, and therefore, I think there'll probably be a bit of a nice surprise with yields coming off as and when the markets sort of face that adjust to the reality. Um, but I think when it comes to central banks, the big issue right now is linked to that sort of fiscal stimuli and the increasing indebtedness. It's all the fears of essentially fiscal dominance, right? When debt levels are increasing, that could have a knock-on impact in terms of central banks needing to react just because high levels of debts can generate um, financial market instability and central banks are forced to react. And any new catalyst could drive that shock that makes that fragility become a lot more apparent. And this, shock that we're living in right now could be, the opening seeds to that. And once again, that's an environment where gold will react very, very strongly. Gold is seen as the antithesis to fiat currencies, paper currencies, because its supply is relatively fixed. And therefore, gold is likely to be a very strong asset in that environment.
Thanks, Nitesh. I'll moderate in Chris's absence. He is my colleague. With that, let me shift to Doug. Hopefully, you guys are hearing me as well. With
Yeah.
tariffs now averaging above 10%, we're seeing a reshaping of global trade flows. Uh, Doug, in your view, does this create a structural floor for commodity prices that historical models or relationships might be missing? And how do you see overall trade impact on
Yeah.
commodity flows?
Um, that's a good one. I think context is incredibly important when we start to talk about tariffs, and you want to analyze or infuse tariffs into any sort of projection about any asset class, commodities, stocks, bonds, etc. So I think context is important. About a year ago, I believe, Akesh, somewhere around right around now, I believe, we were a little shocked by some of the numbers we were being discussed related to tariffs and what we were going to incorporate into our analysis and our outlook. We've come a long way since Liberation Day, I guess. I guess the effective tariff rate that's in motion right now, that's in place, is a lot lower. You mentioned 10%. Our math is even somewhat a little bit below that. Um, and tariff revenue has slowed. So I'll start by saying that it's not as impactful as it could have been to providing a structural floor to the commodity complex. That said, thematically at least, tariffs do create a bit of a structural support for the commodity complex and the industrial complex, right? It increases the cost of raw materials, the import costs. It encourages a lot of domestic production, and that sort of shifts, short-term shocks around, and it encourages restructuring. So, while tariffs for specific domestic industries, and that includes a lot of the commodity-related industries, will benefit, there is a tax associated as well. So you've got a bit of a mixed view when you try to incorporate somewhere around 9.5, 10% tariff rate. I'll add this to this discussion related to tariffs. A lot of the commodity asset classes, or a lot of portions of the commodity asset class, let's say, um, the supply associated with them, it's increasingly concentrated in at least a large share of the supply or the logistical transport areas in geopolitical hotspots. And we don't see that changing, and tariffs only add to that. So I would say somewhat of a tailwind to a structural floor, Akesh, but not something that quite a bit different than what we were incorporating March of 2025.
Thanks, Doug. I'll cede my moderation duties back to my colleague in the West Coast. Chris, off to you. I think we're up to question 3 now.
Thank you very much. I apologize for that, dealing with some Wi-Fi issues where everything's shut down. And as I'm sure all of you have dealt with this in the past, where when you need technology to work and different devices, there always seems to be some guardrails there. Well, Akash, we've seen central banks buy gold at record paces. I know there's been discussions that we've had in the field and hearing from others, is there a weaponization of the dollar? What other elements are you seeing, and is this a fundamental shift in the global monetary system?
Sure, absolutely, Chris. And I would note that hard assets underpin our Wi-Fi and technology systems. So it's important to realize while we're providing a soft skill set in this webinar, it's the hard assets that allow it to happen. Within that context, look, I do think we have seen a structural shift, really starting with the global financial crisis. And since then, as far as official sector reserve diversification, de-dollarization trends, holding more gold as a share of allocated reserves. And I think that trend is still set to continue. We take a real bird's eye view for about 4 decades prior to the global financial crisis. So going back to the Nixon shock in 1971 and the US exiting the Bretton Woods system, central banks globally were net sellers of gold for 4 decades. Not every year, but call it 8 out of 10 years, Chris, of around 200, 220 tons per annum on average. But the global financial crisis really changed that banking crisis, that bailout, the trust system. It really shifted central bank allocations. And that first started in 2010. It was a very small portion of gold purchases were going into central bank vaults, around 10% of primary mine supply, maybe 50% of primary mine supply. But the Trump administration has really accelerated that. First, in 2018, with the U.S. trade spat or U.S.-China trade war part 1, you really saw global central banks led by emerging market central banks shift out their demand to, at the time, what was the highest in about 40 to 50 years, 600 to 700 tons per annum, both in 2018, 2019, in the back U.S.-Sino trade war. And then again in 2022, with Russia-Ukraine war, you saw another increase from central banks. They started buying 25 to 30% of primary mine supply into their reserves. So, look, I think this is a leg that has many years left to go. Statement on where we want target reserve allocations to be. Gold already overtook the euro at the end of 2024 as the number two reserve asset in the world after the dollar. And if you look at kind of the US dollar share of foreign reserves and allocated accounts, it's fallen from 65% to now 56% over the last 2 decades. So it's a slow burn or slow grind lower. And I think gold incrementally is making up more of that share. As far as the weaponization of the dollar, absolutely. US sanctions policy, the use of foreign policy doctrine that might be changing under Trump. I think that potentially over the long term accelerates potential reserve diversification away from dollar assets.
Thank you. Nitesh, are you kind of in a similar consensus in what you're seeing around, central bank buying and the reasoning there? Or, I guess kind of in addition to that, I guess how much room to run do these central banks have as far as their purchasing capability?
Yeah, I mean, I'd agree with that, Cash, that 2022 was the watershed moment, right? That really weaponization of not just the dollar, but all G7 currencies meant that central banks were all spooked and are looking for alternatives. Um, Now, since 2022, central banks on average are buying double the volume that they had been buying prior to 2022, in the decade prior to 2020. That's the scale at which they've stepped up their purchasing. Now, I can see that going on for decades to come. So if you saw in 2023, 24, 20, we saw more than 1,000 tons of gold buying in those years. 2025 dipped a little bit below. But if you look at the gold price, it was substantially higher. So what they were spending in dollar terms or in euro terms or yen terms or whatever on gold was much higher. So that scale of buying is actually increasing. What they're swapping out from other FX reserves into gold is large as their assets and those other things mature. Um, Now, if you look at countries like China, its gold relative to other FX reserves is relatively small, 7-8%. You compare that to the US with 80 odd percent, or Italy, Germany, France with roughly 70 to 80%. It's got a long way to go. Even Russia has something like 30 odd percent gold relative to other FX reserves. And when you're a country like China, and obviously it has massive FX reserves in general, but you can clearly see a point of vulnerability, right? And so the pace at which it's buying right now, it can do for decades to come and still not catch up with some of the other big central banks.
Not necessarily something that we discussed in the past, but we've seen even where there's a new source of demand in like stable coins, like Tether being one of the largest buyers of gold. How are you seeing that potentially affect gold prices as being a new source of demand in this current environment?
Yeah, I think that can have two-way flow, Chris, but I think it's a positive certainly for 2025. Tether was the number two largest gold buyer globally after the Central Bank of Poland in 2025. And what I think is interesting is that Tether might be bringing in new gold buyers that are crypto native or would otherwise shun gold investment through a traditional channel like an ETF or holding physical bar and coin. So to the extent that its reserves continue to expand and grow, it is the largest stablecoin issuer in the world, based in El Salvador, but globally fungible. I do think that is a net positive for aggregate demand. Now, that doesn't mean if they unwound their holdings. That couldn't be a negative temporarily. But as they're building out this infrastructure and frankly also investing in the gold stream, they've gotten involved in royalty plays and mining interests, et cetera. I do think on balance over the last couple of years, it's been a net positive and has shifted the aggregate demand curve out for gold.
Thank you.
I would also add that it's not just Tether who are the new buyers of gold. We've seen Chinese insurance companies become eligible to buy gold last year, Indian pension funds at the end of last year. And they all had significant volume. And you look at the scale of new buying from China. I mean, China is in the last year, the flows that have gone into Chinese exchange traded products have doubled the assets under management in Chinese ETPs. So, I mean, there's a lot of new buyers in gold, which may change the behavioral characteristics of gold going forward.
Let me jump in for a second, Chris. I'm curious because our house view here is that there's been some weaker hands in the precious metals space. And you sort of saw that with the gold sell-off and the silver sell-off, a couple months ago. Akash or Nitesh, I understand the structural investment from central banks and others, but what is the view on related to some, let's call it more retail investors, less time, lower duration type holders? Any thoughts there?
Well, I think January was more of a gamma squeeze in the market. And, at one point in January, gold was up 30%, silver was up 60% intra-month, meaning in just a 2, 3 week period. I mean, that's unsustainable. Volatility in silver was realizing about 120 vols. That is not sustainable. Even today, year to date, silver is actually more volatile than Bitcoin, traditionally the most volatile, quote unquote, alternative asset, a liquid asset. I think in the gold side, March has been a historic month of unwind. A lot of people have been using gold as part of their liquidity and alternative sleeve to raise cash. You had a lot of Fed repricing that we talked about earlier prior to the war. We're looking at 58 basis points of cumulative Fed easing this year. Now we're looking at a Fed on hold for longer. And just last week, a 60% chance of a Fed hike this year. I think that was overdone, got ahead of its skis. So I think in that context, gold the sell-off in March is not necessarily weekend, it's just rebasing. Gold is still up 6 to 7% year to date. Yes, we're at outflows over the last 3 months because we had very strong inflows in January, February across the ETF space, large outflows in March. But you kind of look at it on a rolling, even 6 month basis, or you look at it on a year basis, it's still an asset class that is underowned. It can be overbought on the technicals, but it's still underowned. And just to give you guys one stat, and I'll pass it back to you, Chris or Nitesh, is that despite the 65% rally that we saw in gold spot price in 2025, you look at global mutual fund and global ETF assets, gold fund share of that was less than 1% at the end of 2025. So I think there's still room to go as far as strategic and even tactical allocations this year, with some of this Fed repricing noise actually coming back into the end of March.
Yeah, I
Thank you.
largely agree with that. I mean, in January, $1,000 were added to gold price in the span of a month. It took most of 2025 to add $1,000, and prior to that, it took many years to get to a thousand added to gold prices. So what that increase we saw in January just clearly was unsustainable. And for silver, it was even worse, right? When it got to 120, it was just that was a bit nuts, and clearly would have choked off a lot of industrial demand because silver is that much more of an industrial commodity. So clearly prices had to come off from that level. But once again, as I mentioned, when you have new investors in movement out of those swifter, then
Is
what
the
was the
sound
question?
going?
Just on my end, Nitesh, you're cutting off quite a bit.
Okay.
You might
Any
you
better
want to.
now?
It's a little bit better
Yeah.
now, but you might want to relog on.
Okay. Okay. Well, maybe you head to the next question, and then while I do some
Yeah.
reconnection.
Perfect. Uh, you know, I think one thing that's of interest here is, we're seeing that the conversation that the CBO is projecting that the one big beautiful bill, instead of being stimulative, will actually add, $1.9 trillion to the deficit in 2026. Doug, I'd actually like to lead with you on this one. How do you hedge the fiscal dominance theme? Does the U.S. and global debt crisis make gold or other hard assets more mandatory insurance against devaluation rather than just an optional allocation?
Yeah, I feel like we've over the decades had to address the fiscal dominance question several times, and obviously it's getting stretched with bigger numbers. And as I'm sure this party can agree, it's not the level of debt, it's the ability to pay. And when that starts to be questioned, then this becomes a much more important question. I'll say this, Chris. It's a growing concern. If you just think of debt to GDP ratios and whatnot, and our ability to fight inflation, given those levels, right? If you raise rates, it becomes costly downstream. Um, so, our view, at least our house view, is that what that means is that tail risks are up related to some sort of monetary mistake. Okay. But that it doesn't really scare us off from an allocation to traditional asset classes. Of course, commodities are a natural hedge when you think about the inflationary impacts and the lack of ability to address those because of high debt levels. The time-tested one thing you can do as an allocator of assets is diversify. So diversification is one of the only ways to control that particular risk, Chris, which leads us right back to the commodity play. So there is definitely a portion for a well-diversified, let's say, portfolio when you start to weave in um, fiscal concerns and debt level concerns.
Yeah, Chris, in that same report that you're referencing from the Congressional Budget Office in February, the estimate for net interest payments on the US federal debt will exceed 1 trillion with a T this year for the first time on record. And that's before US interest rates backed up 30 to 40 basis points across the belly of the curve and across really both the front and long end as in a bear flattening kind of move over the last month of March. Now, of course, rates can come down again if this war ends and oil prices calm. But I would note that the CBO actually uses pretty conservative rate expectations even over the medium term. So those interest costs could even be higher over time. And I think what's critical in that regard is that when you have this debasement risk, how do you visualize this global debasement trade? What do people mean by alternative fiat and that trade? I think the reason precious metals and particularly gold, but you're seeing it also silver in the last year as a kind of a high beta catch-up trade, is that you're seeing concerns or higher risk probability of a developed market restructuring event. So as you have higher term premia in the interest rate curve, and what I mean by higher term premium is you essentially have a higher cost of borrowing for the US government because there's a supply demand mismatch in US Treasury issuance. So I need to be compensated more as an investor. As that happens, you essentially have a situation where these government bonds are losing some of their safe haven appeal. Duration risk is much greater, even when you have crises like in March. The 60-40 portfolio did not perform well in March. But treasuries were not a safe haven in March. So I think from that standpoint, that's a very much a concern. And I think it provides a little bit more room for diversifiers in the precious metal space, particularly gold is kind of as a lower volatility precious metal.
I know for our client base, there was a big flag, Chris, when the interest costs actually exceeded military spending. That was a big wake-up call domestically for a lot of our clients, and we had to answer how we see that playing out. So it's certainly worth monitoring.
Yeah. Um, yeah, I feel like any conversation on metals isn't complete unless we talk more about AI. Yeah, I know we talked quite a bit about the AI data center build outs and a lot of the demands there. Obviously, it's going to require a massive amount of silver, copper, other industrial metals, for power, cooling, just general circuitry. Uh, Doug, is the AI boom turning silver industrial metals into that multi-year bull cycle that you had referenced? Are we We've seen a
Yeah,
pullback recently? Is this
it's
over?
certainly contributing, Chris. Certainly contributing. We just attended the largest um, optical fiber conference of the year, and the bottom line takeaway is that there's just no let up in demand for higher capacity connectors, and that includes a lot of these commodities we're talking about: copper, industrial metals, et cetera. So these AI workloads, we continue to have an environment where demand for compute, let's say, is outstripping supply, and that requires an ever expanding set of power and cooling needs, and that plays right into the commodity cycle. Did a tour of a modern data center recently, and this is 100 plus megawatts. This is a lot of power. And some of the largest newer ones are 600 megawatts, 650. So it's the size of like a medium-sized nuclear or medium-sized power plant. It's a lot. It's a lot of power. And when we get into the inference stage of AI, we just don't see it letting up. So yeah, at this point, we don't think we've overbuilt, and we think that the power trends related to AI are a natural tailwind. Just one word of caution that we're picking up related to this theme, affordability is a hot topic these days. And, as the power needs related to AI start to weave into utility bills and whatnot, investors should keep an eye out on how that plays out. But tactically, at least, or let's say for the immediate term, Chris, AI definitely a tailwind to the complex.
So you feel that the market is kind of in line with the build out speed?
Yeah, and I think the question is it overbuilt? And our house view is that no, it's not. We continue to see data points that would support the idea that spending is at pretty robust levels, will be sustainable for years to come.
Maybe a
See,
comment I could add is that the power needs for data centers and AI, um, they power hungry, but and they're willing to spend more on energy than maybe other sectors. And then when you've got commodity production, which is very energy intensive itself, especially things like aluminium, um, it becomes difficult to expand production of things like aluminium. And aluminium production has already fallen with the first energy crisis in 2022. It's falling again now with this Iranian crisis. Um, if aluminium has to compete with data centers, it's going to become even harder. So there's a demand aspect to it, and there's also a supply aspect to this as well, which are both acting as catalyst for commodity prices.
one thing that kind of segues into the next question here. With silver hitting $94 an ounce, and I apologize if this was addressed on a segment where I was kicked offline. Um, and also looking at the aluminum or aluminium, tomato, tomato. Is there a deficit in the mining sector? Like what's driving a lot of these prices, and how should investors think about these two metals or any other industrial metals involved in this general space, as far as a pathway for investment?
And maybe my thoughts first. So, for silver, when it got to the crazy levels of $120, that was just speculative aspects, right? Silver's a relatively small market, and there was just a lot of investor interest, largely, from less traditional investors, and that swung the price very hard. But apart from that, I mean, look at 2025. I think the price increase we saw during the course of that year were fairly justified, right? There is a supply deficit in silver, and its demand is just increasing because of electrification needs. And its supply won't increase that much because it's a byproduct of mining for other things. So, however high silver prices go, there's not going to be that much new mining for silver unless copper prices or nickel prices or zinc prices go up because that's the primary thing that the miners are looking for, right? So, um, in the market for silver can remain quite tight. But if we get sort of $100 for silver, then you're going to get a huge amount of thrifting. And we're already seeing that in solar panels already. Less silver is being put in each panel to be able to save costs, with more copper being used instead. Um, so there is that little bit of a dynamic there. Other things in the AI story, yes, copper and aluminium are massive in demand. Copper is in a supply deficit at the moment, but that's mainly because of a supply disruption last year. A mine went offline and it's made it very tight. Um, Now, it's that mine's not going to come fully back online until 2027. So we're living in this period of tightness. In aluminium, once again, there is probably a little bit more supply than there is demand, at least at the beginning of this year. But the Iran-related disruptions are probably taking aluminium to a deficit. But we were thinking of deficits in the next few years for aluminium anyway, because um, China has got capacity constraints, policy-related capacity constraints, and the rest of the world hasn't been expanding production. So that it probably fits more into that bucket of lack of investment through the rest of the world and demand just continuing to rise. So, there are issues of, under supply, and the capex cycles are huge, right? I mean, talking 5 to 10 years. So even when we recognize all these issues today, suddenly building out a whole lot of new plants just won't fix the problem. It will only get that new supply coming in a number of years.
Yeah. Doug, from your position as a practitioner and managing wealth, for some of these various metals, I mean, obviously we've seen gold sometimes as a standalone position, seen silver more so. Um, do you see some of these other industrial metals as a direct allocation in a client portfolio, or is this something that you would expect investors just to pick up more in a broad commodities exposure?
Usually the latter. It's a challenge sometimes to making a direct investment, and we do that occasionally in, let's say, a specific rare earth metal. That's just hard to do. And there are a lot of stocks and or ETFs that you can invest in that have very high correlations to the underlying commodity price, particularly either, excuse me, certainly in gold or in silver, but in some of the rare earths. That's one thing that we've been looking at is gallium, graphite, cobalt, aluminum, copper. Where are we where there is a high reliance, or we call it net import reliance, on something that's needed somewhere within the technology chain, for example. So we start with that, and then we say, okay, how do we go invest in that? Well, it can be a bit of a challenge to make a direct investment, let's say for a family office and client in a company that's based in, let's say, China. So a lot of times we'll just pick an ETF or a common stock highly correlated to the underlying and go that route.
Yeah. Yeah, I seen on that topic from when you look at direct investment opportunities versus more of kind of the public equities, like how do you trade off that risk reward parameter and liquidity as you look at various opportunities?
So maybe, at WisdomTree, we build indices and products that track lots of these themes. So, rare earth miners and strategic metals value chain. So, looking at the equities across the full value chain from extraction to final product. That's something that's available in Europe. We also do offer indices and products that look at the metals in the in energy transition or strategic metals, ranging from copper, aluminium, lithium, cobalt. Um, Now, when it comes to the latter, so looking at the metals, We're investing in rolling futures types of strategies, and we have to be liquidity conscious, right? So, um, yes, copper and aluminum is highly liquid. They can be completely unconstrained, but lithium and cobalt very unliquid, illiquid. So we have a strategy that's kind of built on, future demand prospects and looking at today's supply demand imbalances for most of these metals. But for cobalt and lithium, we just have to cap it because if you um, don't cap their weights, the whole product becomes illiquid. For the equity type of strategies, once again, we have screening criteria on the liquidity of the underlying equities. But we can go very broad with this. We can give exposure to China, and China is obviously the leader in most of the processing of all the materials in the energy addition or transition. But we have to do it in a very careful way. You have to make sure that they are large enough companies. They have enough track record. We look at some volatility measures of these equities to make sure we screen off and make sure we're not exposing ourselves to excessive volatility.
Of course. Looking at again the AI build out, the demand for energy and also the demand for metals. Yeah, from your perspective, Doug, starting off here, like, does the lack of energy supply outweigh the I guess the lack of supply on the metal side as being a more reliable alpha generator? Or I guess how are you looking at the two, and which one do you feel it might be a more reliable alpha generator for investment?
The power side is where we're focused. I mean, it's a choke point for the build out right now. So, that means a lot of things. How do you address that choke point? How do you get power? Well, what we're seeing is it's a bit of an agnostic view. We have new data centers that are going to be nuclear power driven. We have others that are gas power driven. We have some, and anything in between. So we're taking that approach, and what that means is it sort of spreads out the spending, if you will, Chris, across the complex. But there's a natural tailwind or natural lift supporting quite a few factors within the complex. So again, it's a tailwind, but we're not tying, at least for my firm, we're not going to be tied to one singular addressable energy source for the AI demand. We want to spread it out.
No, I mean, diversification is key, right?
Yeah.
Nitesh, for you, being head of commodities at WisdomTree, it's actually a question from the audience. What commodity do you feel is currently undervalued by the markets? And, what is the market missing that is causing that commodity to be undervalued?
Yeah, I kind of mentioned it earlier on, but I think aluminium is particularly interesting. I know it's popped up in the last couple of weeks because of damage to smelting infrastructure. But even before that, I think that we were turning towards a much more tighter market. Those decades of China overproduction is basically over because of capacity constraints and lack of production and elsewhere, and the fact that the U.S. tariffs on aluminum production aren't going to really lead to more production in the U.S. because most smelters in the U.S. have said we need to be able to invest over one political cycle, and we don't know whether these tariffs are going to be around for after one political cycle. So I think that tightness in aluminium is still there. But if you want a slightly more obvious trade, I think copper is pretty much there because it really is the poster child of this transition aspect. It used to be called Dr. Copper because it was read the temperature of the economy and therefore gave an indication of cyclical demand and copper prices used to rise, but it's becoming progressively a lot more structural in terms of its story. In fact, the cyclical story has been here or neither here nor there in the last 5 years. It's really the structural story from electrification that's been driving the metal.
Yeah. So, Nitesh, does this mean that I should be saving my cans in my house and hoarding that aluminum and waiting for, when prices spike before I sell it on the open market? Or, the 10 cents or 5 cents per can here in California that I'm getting fair market value for. Well, I guess I'm
Yeah,
actually
I
just getting my
mean,
money back, I guess.
funny enough, aluminum scrap is quite valuable because it's exempt from the tariffs. So a lot of scrap from the rest of the world has been going into the US because it has been exempt from tariffs.
Well, I appreciate that. We'll kind of move into some quick questions. I want to adjust a few more points here. I know we're getting close on time, but I think it's really important just to address, the price of Brent crude. Akash, we'll give this to you here. With Brent crude where it's at and the conflict in Iran, how much of a war premium is currently being priced into, Brent crude, broader commodities? Yeah, we keep hearing that oil could end up hitting 150, $200 a barrel. Like, is there something that the market is underestimating here? And I guess where could potentially we go from here?
I think it depends on the evolution of the conflict and how long the strait stays closed. If you look at how prices evolved from $65 to 85, then 85 to 95, and then 95 to kind of the mid low 100s. The first was the closure of the Strait of Hormuz, which moves 20% of U.S. crude and global crude and hydrocarbon product. Then the next stage was actual attacks on energy infrastructure. And then the third was also shut in production. So if you're producing an asset that requires storage onshore and you're not able to ship it, well, then at some point you have to shut down the extraction. So kind of those three legs have pushed prices to the hundreds, to the low 100s. I think if the war persisted for another month, right? We've been 1 month of war. If it lasted for another month, you would exceed the 2022 Russia-Ukraine highs. And you would get above $150 a barrel. Already product prices are pretty tight globally, jet fuel, fuel oil in particular, tightness in middle distillate market. So I do think that is a concern. Are we at prices high enough yet that you're going to really destroy demand? Not really. You might see a 1% decline in global oil demand in April, kind of monthly and seasonally adjusted, given this $40-$50 price increase in Brent crude prices during the war on average. But that's not sufficient. So the question is the strait going to open? Are we going to have some de-escalation? And is the market going to kind of price in a new terminal value of around 85, $90 oil, which I think can be more absorbed than $110 a barrel? Else, if the war persists, Chris, I think 150 to 200 is not unreasonable.
Right. A lot of information here around, the what and the why. Get into the how. Doug, with the traditional 60/40 portfolio, not necessarily covering all the elements of, kind of the inflation component and, seeing more demand from investors for real assets. How should, either the end client or, other advisors, institutional clients think around, what's an ideal percentage allocation in your view for a moderate investor to, hard assets and the topics we're discussing? And for someone that doesn't have an allocation currently, how would you source that? Like, where would you pull assets from?
Yeah. Well, that's the $1 million question, isn't it? We think 5% is a good starting point, Chris.
Yeah.
And where would you pull it from? Probably fixed income. Of course, every client's different, but if you think about your traditional 60/40 and where's it going to be pulled from, we at this, where we sit now in our view on the asset classes, it would be pulled from there. Outside the benefits of what we've already talked about related to commodities and the cycle that we're in, and we're pretty much all aligned there. We talk to our clients at least about the rising correlation between bonds and stocks. The need for alternative sources of diversification, right? When inflation expectations rise, stocks and bonds face the same pressure. right? Higher discount rates, potential earnings expectation weakness given the choke off of higher rates, et cetera. So, you know, commodities act as a natural diversifier in that sort of regime, and that's what we're facing. So to us, it makes sense. And a good starting point is somewhere around 5%. I will say this, when you look at all of the assets in ETFs, and a lot of clients on this call will try to get that allocation via ETFs. Commodities in total, by our work, total just about 2.9%. Right. So, back to Nitesh's point, I believe earlier, it's still an underinvested, underowned asset class. And we think that there's plenty of room. I will say this one more time. There are a lot of stocks that trade with very tight correlations to the commodity that you're trying to address. Okay, well-known, very highly liquid stocks. So you can populate the portfolio, get that allocation easily with highly liquid common stocks that track the underlying. So that's been our approach, Chris, to use a sort of a 5% starting point and stay active with it.
Good.
Maybe I can, if I can add to that. We've done
Yep.
some quantitative analysis, looking back at sort of optimizing risk-adjusted returns in portfolios of equities, bonds, and adding commodities. And the results actually surprised us. From a quantitative standpoint, the optimal holding would be somewhere between 15 and 20%, which sounds like a lot. I don't think many
Yeah.
people have that kind of holding. But in recent years, I've been speaking to more and more clients who are moving more towards that, recognizing possibly that they've done kind of similar analysis on their side. And maybe as an additional point, it doesn't have to be a very hard choice on how to make that allocation, because there are strategies that can do this in a very capital efficient manner. We've built out these strategies called efficient core, where you hold, say, a bunch of equities, say a portfolio of 90% equities, and then the 10% you allocate into futures in an unfunded manner. And by doing that, you get that sort of kind of leverage, which gives you a 90% exposure to equities and a 90% exposure to the other, which, it could be gold or it could be, a broad commodity basket. So that kind of approach gives you a lot of room in your portfolio without really making much more room. You're only giving up, your 10% of your equity allocation. You get a very large new exposure to, the commodity exposure, maybe gold.
Perfect. Yeah, no, in the final minute here, I want to see if we can get this off in about 20 seconds each. We'll go Doug, Akash, Nitesh finishing up here. What's the single biggest risk to the commodities bull market? And what is one asset class that you would overweight today in one or two?
Demand for me, commodities are oftentimes a supply and demand story, and I don't think that's going to change. So the risk to the cycle would be that demand, that's the way we look at it, or growth softens. And that's not our view, by the way. That's not our base case. We think demand will be fine. But demand for me is the one area to watch.
And the one asset class to overweight?
Copper.
Okay. Akash?
Yeah, look, I think precious metals is a good asset to overweight after the March drawdown, because I think there's a room to run, and I think Fed pricing got ahead of its skis in mid-March as far as hiking probabilities. And then I agree with Doug, commodities are pro-cyclical. So if you're going to have a global recessionary environment, but it's not truly stagflationary, that's going to shift the aggregate demand curve inward, and you're going to have a weaker environment there. But then the rebound could be quite strong. It just will come in a delayed fashion.
All right, Nitesh, we're trying to fit this in here.
Yeah, so my view is that demand possibly will move slower. We could, I mean, as a surprise, not once again, this is outside view, not what we think, but if all the wars were to end, right, the Russia war, Iran war, and supply were to assimilate very quickly, then that would be the most negative thing. And I think, it's the supply shocks that have been sending the spikes in commodity prices. If those were to reverse, that would be the most sort of bear case scenario. And in terms of where to overweight, we discussed aluminium earlier.
Perfect. Thank you so much. I appreciate all who stayed with us the extra minute here, and thank you all for joining us. I'll turn it back over to the CFA.
So thank you everyone for joining us this morning. I'd like to thank Doug, Akash, Christopher, and Nitesh again for joining us this morning, and everyone have a great and wonderful day. Thank you very much.
Thank you so much.
Thank you.